Look, I need to talk to you about building real wealth in 2026 because what you're hearing from financial advisors, from the media, from these so-called experts is going to lead you straight into financial disaster. And I cannot sit here quietly while another generation gets wiped out by following conventional wisdom that is fundamentally based on lies and misunderstandings about how economics actually works. Everyone is telling you to build a portfolio with 60% stocks, 40% bonds, maybe throw in some index funds, dollar cost average your way to retirement, and you'll be fine. The Fed is telling you inflation is under control. The economy is strong. Just keep buying and holding. And I'm sitting here watching this unfold thinking, how is it possible that people can't see what's right in front of their faces, which is that they're accumulating wealth denominated in a currency that is being systematically destroyed. And when this house of cards finally collapses, everyone is going to act surprised, but they shouldn't be surprised because the warning signs are everywhere. Here's what nobody wants to tell you about building $1 million portfolio in 2026. That $1 million isn't what it used to be. $1 million today buys what maybe 600,000 bought a decade ago, and it's going to buy even less tomorrow. So when I talk about building $1 million portfolio, not talking about accumulating 1 million units of depreciating Federal Reserve notes, I'm talking about accumulating real wealth, real purchasing power, real assets that will maintain their value when the dollar inevitably continues its march toward worthlessness. This is basic economics, Austrian economics, understanding what money actually is and what gives it value. The conventional approach to building wealth in America today is completely backwards. You're told to save dollars, invest in dollar-denominated assets, and trust that compound interest will work its magic over 30 or 40 years. But here's the problem with that entire framework. It assumes the dollar will maintain its purchasing power. It assumes interest rates reflect real market conditions. It assumes the Federal Reserve knows what it's doing. And all three of those assumptions are catastrophically wrong. The Fed has been manipulating interest rates for decades, keeping them artificially low, inflating asset bubbles, and destroying the savings of ordinary Americans who are trying to do the right thing. Every time you put money in a savings account earning 1 or 2%, while real inflation is running at 7, 8, maybe 10%, you're losing purchasing power. You're going backwards. The system is designed to transfer wealth from savers to debtors, and the biggest debtor of all is the United States government. So let me tell you what's really happening. When someone follows traditional portfolio advice today, they're buying stocks at all-time highs that have been inflated, not by genuine economic growth, but by the Fed's money printing. They're buying bonds that are going to get crushed when interest rates eventually have to rise or when inflation continues to accelerate. They're denominating everything in dollars that are being created by the trillions. The S&P 500 might go up in nominal terms, sure, but what's it doing in real terms? What's it doing when you measure it in gold, in real money? The stock market has been going sideways or down for years. When you price it in gold, because all these gains people think they're getting are just keeping pace with or falling behind the debasement of the currency, you haven't gotten richer. The measuring stick has gotten shorter. Now, everyone wants to know, Peter, if the conventional approach doesn't work, what should I do? How do I actually build wealth? And the answer is, you need to understand that wealth is not paper. It's not digital entries in a computer. It's real productive assets. It's commodities. It's things that have intrinsic value. Gold and silver are the foundation. I've been saying this for years. and people mock me for it. They call me a gold bug like it's an insult. But gold is money, and it has been for thousands of years, and it will continue to be after the dollar joins every other fiat currency in the graveyard of failed monetary experiments. When you own physical gold, you own something that cannot be printed, cannot be inflated away, cannot be defaulted on. It's no one else's liability. You're not trusting a government or a central bank or a corporation. You're holding real wealth. But here's where people get this wrong too. They think I'm saying put all your money in gold and bury it in the backyard. That's not what I'm saying. I'm saying gold is your foundation, your insurance, your store of value. But you build wealth through productive assets, through businesses, through investments in real economic activity. The difference is you need to be smart about where those assets are and what currency they're denominated in. You need international diversification. You need to get assets outside of the United States, outside of the dollar system. Because when the dollar crisis comes, and it is coming, you don't want everything you own tied to that sinking ship. Let's talk specifically about building to that $1 million target. First, you need to fundamentally change how you think about saving versus investing. In a sound money system, saving is investing. When you save gold, you're preserving purchasing power, your foundation. This is what protects you when everything else falls apart. Second, you need exposure to businesses and assets that will benefit from the trends I'm describing. Mining companies that are producing gold and silver are criminally undervalued right now because everyone is chasing tech stocks and meme stocks and all this speculative nonsense. These companies are pulling real money out of the ground, and their stock prices don't reflect what's coming when people finally wake up to the monetary crisis we're in. You want companies with real assets, real production, and preferably located in jurisdictions with better economic policies than the United States. Look at Canadian mining companies, Australian resource companies, places where you're getting exposure to real commodity production without all your eggs in the U.S. regulatory and tax basket. Building wealth. In our current debased fiat system, saving dollars is losing money, so you need to save in real assets. Start with physical precious metals. I'm talking about building a position that represents maybe 30, 40, even 50% of your portfolio in physical gold and silver that you own outright, that you can hold in your hand or store in a secure facility that you control. Not paper gold, not ETFs, not futures contracts, physical metal. This is third, international real estate in markets that aren't as inflated as the United States, in countries with sounder fiscal policies. I'm not talking about buying condos in Miami. I'm talking about productive agricultural land in stable countries, rental properties in markets with actual positive real yields. Real estate that you could potentially move to if things get bad enough in the United States. Real estate that generates income in currencies other than the dollar. Diversification isn't just about asset classes. It's about currency exposure and geopolitical risk. Fourth, and this is controversial, but I'm going to say it anyway, you need to be very careful about traditional retirement accounts. Everyone says, maximize your 401 kilobits, get that employer match. It's free money. But what you're really doing is locking up your assets in government-controlled accounts that are denominated in depreciating dollars and subject to rule changes and tax increases down the road. The government is going to be desperate for revenue as the debt crisis intensifies. You think your 401 kilobits is yours? They can change the rules. They can force you to buy government bonds. They can increase the taxes on withdrawals. I'm not saying don't participate at all, but I'm saying be very skeptical of putting all your wealth into accounts where the government has complete control and can move the goalposts whenever they need to raise revenue. Now, let's talk about what you should avoid. Long-term bonds are certificates of confiscation. You're lending money to the government for 30 years at interest rates that don't come close to compensating you for the inflation risk. That's insane. If you understand that the Fed is trapped, that they can't raise rates without crashing an economy that's built on debt, and they can't keep rates low without accelerating inflation, then you understand that bond holders are going to get destroyed either way. Either rates rise and your bond values crater, or inflation continues and your real returns are deeply negative. There is no scenario where being a long-term creditor to the U.S. government makes sense right now. Bitcoin and cryptocurrencies. Look, I know this is going to upset people, but these are not alternatives to gold. They're speculation. They might go up, they might make people money in the short term, but they're not money. Gold is money because it has intrinsic value, because it has industrial uses, because it's been valued for thousands of years across every civilization. Bitcoin is computer code. It requires electricity. It requires the internet. It requires belief in the system. When things really fall apart, when you need to actually use your wealth, you want something physical, something universally recognized. I'm not saying Bitcoin goes to zero. I'm saying don't confuse speculation with sound money principles. The conventional stock market is another area where you need to be very selective. The indices are dominated by a handful of mega cap tech companies trading at astronomical valuations based on the assumption that cheap money lasts forever. It doesn't. When the Fed loses control, when rates have to rise, or when inflation expectations become uninsured, these high-flying growth stocks are going to get crushed. If you're going to own stocks, own things with real assets, real earnings, dividends, companies that produce things the world actually needs, energy companies, material companies, agricultural companies, things that benefit from inflation rather than getting destroyed by it. Here's what a real wealth building strategy looks like starting from scratch in 2026. You need to completely reprogram your thinking about what wealth means. Every month, whatever you can save, you're converting a portion into physical gold and silver. You're building that foundation. You're looking for opportunities in undervalued resource stocks, particularly precious metals miners. You're researching international opportunities, maybe opening accounts with foreign brokers, looking at real estate in countries with sounder policies. You're minimizing your exposure to dollar-denominated debt and paper assets. You're thinking like someone who understands that the emperor has no clothes, that the dollar is not sound money, that the Fed doesn't have a plan, that this ends badly. And look, I know what people are going to say. They're going to say Peter Schiff has been predicting doom forever. The dollar hasn't collapsed yet. Maybe this time is different. But here's what they're missing. The process is already happening. The dollar has lost over 95% of its value since the Fed was created. It's not about whether this happens. It's about the acceleration of what's already been happening. We're further down the road than we've ever been. The debt is higher. The Fed's balance sheet is more bloated. The distortions are more severe. Every crisis they've papered over with more money printing makes the ultimate reckoning worse. The difference between building wealth the right way and the conventional way is going to become crystal clear over the next 5 to 10 years. People who followed traditional advice, who have everything in dollar-denominated stocks and bonds and bank accounts, are going to watch their purchasing power evaporate. They're going to be million-dollar millionaires on paper who can't afford the same lifestyle that 100,000 used to buy. Meanwhile, people who understood sound money principles, who accumulated real assets, who diversified internationally, who owned physical gold, are going to preserve and build real wealth. You want to get to $1 million. Fine. But understand what that means. In real terms, in purchasing power, you need to accumulate assets that will maintain value while the currency deteriorates. That means starting with gold as your foundation, maybe targeting $200,000 to $400,000 worth of physical metal as part of your $1 million goal. That means another $300,000 to $400,000 in productive assets like mining stocks, international equities, real estate outside the bubble. That means keeping some liquidity, but in multiple currencies, not just dollars. That means being willing to be contrarian, to ignore the mainstream advice, to be mocked by people who don't understand economics. The path to real wealth in 2026 requires understanding that we're living in a fantasy land where people believe the Fed can print prosperity, where debt doesn't matter, where deficits are just numbers on a page. This fantasy is going to end. It has to end because economics is not optional. Mathematics is not optional. You can't consume more than you produce forever. You can't borrow indefinitely. You can't print your way to prosperity. These are laws of economics as certain as the laws of physics, and they're going to reassert themselves. When I started warning about the housing bubble in 2006, people thought I was crazy. The Fed said there was no bubble. Bernanke said subprime was contained. I was told I didn't understand the new economy. Then 2008 happened, and everything I warned about came true. I'm not bringing this up to brag. I'm bringing it up because we're in an even bigger bubble now. Everything is inflated. Stocks, bonds, real estate, all propped up by the Fed. And this one is going to be worse because the debt is so much higher and the Fed has already used all its ammunition. If they can't cut rates to zero, we're already there. They can't do QE. They already did trillions. The only tool they have left is the printing press, and they're going to use it until the dollar is worthless. So you want to build $1 million portfolio, build it in real assets, build it in gold, build it in productive businesses that will survive the monetary crisis. Build it outside the dollar system. Build it with the understanding that the conventional wisdom is leading people off a cliff. The bill is coming due for decades of living beyond our means, of consuming more than we produce, of financing everything with debt and printed money. You can either prepare for that reality or you can pretend everything is fine and get wiped out with everyone else who trusted the system. I've been warning about this for years, and I'm going to be proven right again. The only question is whether you're going to listen this time or whether you're going to learn the hard way like most people did in 2008. The choice is yours, but the clock is ticking, and the longer you wait, the harder it becomes to protect yourself from what's coming.